The price-to-earnings ratio, or PE ratio, is one of the most common ways investors look at a company's stock price. The ratio essentially tells you how much you are paying for every $1 of a company's annual earnings. To calculate it, you simply divide the current market price of one share by the company's earnings per share over the last year. A high ratio might suggest investors expect high growth, while a low ratio could indicate the stock is undervalued or facing challenges. Different sectors have different norms, so it is usually more helpful to compare a company to others in the same industry. As you can see, investors may be willing to pay more for earnings in fast-growing sectors like technology compared to stable utility firms. Remember that a single metric cannot tell the whole story. Always look at debt, cash flow, and management strategy alongside the ratio. Understanding valuation ratios is just the beginning of your research journey. Like and subscribe for more basics.